Okay, very excited to have on the Goldstein on Gelt show Jesse Felder, who worked at one of Wall Street's largest firms. He was a co-founder of a multi-billion, billion with a B, billion-dollar hedge fund, and he's been managing investments for over 20 years, actually much like I have. And now he publishes a report called The Felder Report at thefelderreport.com. I'm guessing I can figure why you chose that name, Jesse.
Yes. Actually, I was trying to think of a name. I was a big fan of Stephen Colbert at the time, and Colbert Report. I thought the Felder Report, it just makes sense.
There you go.
Pretty simple.
Hence, I chose the name Goldstein on Gelt too. I considered calling my show the Felder on Gelt. That would have been goofy. All right, so tell me something. I know you talk a lot about the stock market. You've got a huge amount of background in it. Give me a sense of what's going on in the market today in terms of, there's been a lot of excitement. There's been certainly a lot of talk, let's say, since the elections. What should people think when they see, this huge amount of, movement in the market and certainly, the upside that we saw in the beginning of the year?
That's a great question. It's something that a dynamic that we've been watching for a longer period of time, much longer period of time, actually throughout the course of this entire bull market that I think is really getting loud right now, which is just basically this transition from investors interested in actively managing their investments or allocating their money to active managers to the push towards passive investing, and mainly through the use of ETFs. And this is a trend that's just been picking up steam and really over the last several months has just gotten massive. And I think this is really what's driving the markets more than anything, is just people making this shift. And we've seen, Vanguard is taking in, $1 billion a day over the past month. And they're on pace for, I think, to take in almost $500 billion this year, which is pretty amazing. And when that money just flows directly into the largest, companies in the stock market, takes everything up with it. So I think that's exactly what we're watching right now. Do
you think that's just the excitement that people have in the market and they just want to be in it because they don't like making 0% on bank deposits? Or is it that they're moving from active to passive management for some strategic reason?
I think people are discovering, they're learning about the fee structure on Wall Street and how it's not designed to make them a ton of money. And so passive is a wonderful way to reduce your fees. The problem that I see with it is it's completely price insensitive. So, the whole definition of an investment is making sure that your principal's protected and you're going to get a decent rate of return. And there is no analysis in that regard in terms of passive investing. So I think, people in the past, would struggle with that. Is it a good time to buy and all that stuff? And now the whole passive discipline just disregards that entire framework. So people don't even have to think about that. And I think most people believe I just put my money in the markets and I will be entitled to the historical rates of return that we've seen over the last, 30, 40 years. So I really think that's the process driving the markets right now.
Interesting. So people are looking at, not necessarily, if they're looking back before this bull market, if they're, I guess, old enough to have been paying attention to the market, they know that there really can be some scary times. And if they do a risk-return analysis, it's not always obvious that the stock market is the place to be, unless maybe you say, well, I'm a long-term investor. And even then, we always have to disclaim that by saying that past performance is no guarantee of future returns. So is the market being driven simply because of this hype, or is there something fundamental that it's a good idea to be investing?
Well, I definitely don't think the fundamentals support prices today. The valuations in the stock market, when you look at the price to sales ratio, price earnings ratio of the median stock in the S&P 500, it's never been near as high as it is today. When you look at market cap weighted indexes on a price to sales ratio, something like the market cap to GDP or the, Warren Buffett's metric, we're almost as, to where we were back in early 2000. So, price to earnings ratios and things for a number of reasons don't show the market being as highly valued, but they're also less valuable than these other measures. So I think there's a huge gap right now between perception, which is investors. Wall Street Journal ran an article late last week saying the average investor, wealthy investor, expects to earn 8.5% per year on their portfolio after inflation, which means the stock market probably has to do 12, 13%, per year over the next decade. And historically, it's done, 8 or 9%. But with where valuations are today, it's inevitable that returns are going to be much lower than that, probably close to zero or maybe 1 or 2% a year over the next decade. So I think there's a huge gap in what investors think they're entitled to and what they believe they're going to get by putting money into, passive funds today, and what's actually going to happen over the next 10 years.
We're speaking with Jesse Felder, a Wall Street veteran. He's been on Wall Street for over 20 years. Now he writes his ideas at the FelderReport.com. Jesse, you've been talking to us about this, or you just mentioned about this possibility that the next 10 years might see a zero rate of return. We're talking about the stock market, not investing in bank deposits. Why would anyone, therefore, invest in the market?
Because I think it's the biggest mistake people make in the markets, and it's the reason why we get bubbles, it's the natural tendency to extrapolate whatever we've seen over the last 5 years, extrapolate that over the next 5 years. And I think that's what people are doing today, is they don't realize that, one of the most important things Warren Buffett, Ben Graham taught investors is the price you pay determines your rate of return. It's that simple. You pay a high price, you get a low rate of return. You pay a low price, you get a high rate of return. And today, investors for equities, for U.S. equities, are paying one of the highest prices they've ever paid in history. And so just by definition, the returns will be some of the lowest that we've ever seen in history over the next, going forward from this point.
So it sounds to me like you are not a stock buyer today.
Well, I think there's, where I do see opportunity in the market is probably more interesting, is I think one thing that most people don't realize is all these index funds are not just market cap weighted, they're adjusted for float. So companies that have very high insider ownership are ranked much lower than they otherwise would be within the index, because they just don't have the liquidity to make it possible for the indexes to effectively invest in them. So, and this is a problem for back tests too. I don't think a lot of investors understand this. If you actually back tested these float adjusted indexes, they would backtest a lot differently than a purely market cap weighted index, which I think most people believe they're buying into.
So could you spell that out a little more? Could you clarify exactly what you mean by this?
Yeah, so in order to for index funds to be able to invest in stocks in the amount that they need a certain amount of liquidity. And so companies have to have a lot of available shares, to buy. With companies that have a large insider ownership, they have a lot less liquidity. So smaller float of shares in the market. So the index is about 10 years, Vanguard and whatnot, 10 years ago changed the way that they structure their index funds so that they rank these companies with high insider ownership a lot lower than they otherwise would, just based on market cap. And so if you think about it, then back over the last 25 years, you would have owned a lot less Microsoft because Bill Gates still owned a ton of it. You own a lot less Intel because insiders owned a lot of that. So the index funds have actually changed structurally in this way.
But don't the funds just track the index? In other words, if they track the S&P 500...
Well, they track a float-adjusted version of that index. Mm-hmm. So if you go look up, the Vanguard Total Stock Market ETF, VTI, which is their biggest ETF, it doesn't track, the Wilshire 5000 or Total Stock Market Index. It tracks a float-adjusted version of that index. And that's true for Schwab ETFs, all the major total stock market ETFs. And this creates a wonderful opportunity, I think, for active investors to look at companies that have low liquidity, low float, high insider ownership, because they're being ignored by the indexes in some cases. So that's something that I started my career on, is watching insider buying, looking for companies where, the CFO thinks the stock price is cheap, starts buying a ton of stock. And I'm seeing actually a few more of these days, because these companies are actually structurally being punished by the indexes in this way.
That is a fascinating explanation. I know, Jesse, that you explain a lot of other ideas at your site, and unfortunately we are just about out of time now. But tell me, in the last few seconds, how can people follow you and follow your ideas?
Well, the website, I try and write one blog post per week there about kind of things I'm seeing in the markets. But I spend a lot of time sharing stuff on Twitter. It's at Jesse Felder on Twitter, and I'm usually posting 3, 4, 5 different articles a day and stuff I find of interest there. And happy to have a dialogue on Twitter anytime with anyone looking to discuss the markets or whatnot.
Okay, so we'll put a link to your website and to your Twitter account at the show notes of today's show at goldsteinongelt.com. Jesse Felder, thanks so much for your time.
Thanks for having me, Doug. Appreciate it.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Check out all of Doug's money ideas at goldsteinongelt.com. Doug specializes in helping people who live outside the United States handle their U.S. investment accounts. If you have a question that you would like answered on the air or off, contact Doug at his website or send him an email to doug@profile-financial.com.